If you search online for the best investments for beginners, you are going to find 100 different answers. Crypto, real estate, dividend stocks, REITs, gold, bonds, individual growth stocks, peer-to-peer lending. The sheer volume of options is enough to make most people freeze entirely and do nothing, which is the most expensive outcome of all. Today, I'm going to cut through all of that noise and give you a clear, honest answer. We're going to cover the investments that actually make sense for most beginners, why each one works, what the realistic expectations are, what the risks look like, and how to think about putting them together. No hype, no get-rich-quick promises, just a clear framework you can act on. By the end of this video, you will know exactly where to start, what to add as you grow, and what to avoid until you have more experience and a stronger financial foundation. Let's get into it. Before we talk investments, the foundation comes first. Before we get into specific investments, I want to say something important because it affects everything else. The best investments in the world will not help you if your financial foundation is unstable. And by foundation, I mean three specific things. First, a fully funded emergency fund, at least 1 to 3 months of essential living expenses sitting in a high-yield savings account that you can access immediately. We have covered this in earlier videos, and it is always the starting point before anything else. Second, no high-interest debt above 10% interest. If you are carrying credit card balances at 20 or 25% interest, paying those off is the single highest guaranteed return available to you right now, better than any investment on this list. Third, a basic understanding of the account types available to you, particularly the Roth IRA, which we have also covered in detail previously. If those three things are in place, you are genuinely ready to invest. If they are not, those are your investment right now, and they are excellent ones. Get those sorted and then come back to this video with a clear foundation underneath you. Investment number 1, S&P 500 Index Funds. The single best investment for most beginners is an S&P 500 Index Fund. We have discussed this in detail in video 5, but in the context of this video, it is worth being completely clear why it sits at the top of the list. An S&P 500 index fund gives you instant ownership of 500 of the largest companies in the United States: Apple, Microsoft, Amazon, Google, Johnson & Johnson, and hundreds more, all in a single purchase, with near-zero fees requiring no research or ongoing management on your part. It is diversified by design, cheap by design, and historically one of the most reliable long-term wealth builders available to ordinary investors. The specific funds to look at are VOO from Vanguard with an expense ratio of 0.03%, FXAIX from Fidelity at 0.015%, and IVV from iShares at 0.03%. All three track the same index, and all three are excellent choices. The differences between them are negligible. Pick the one available through your brokerage and do not overthink it. What are the realistic expectations? Historically, the S&P 500 has returned an average of around 10% per year over long periods, including all the crashes and recessions along the way. In any given year, it might be up 25% or down 30%. That volatility is normal and expected. Over any 20-year period in the last century, it has always produced positive returns. It is not exciting from year to year. It is extraordinarily powerful over decades. For most beginners building long-term wealth, this is the core holding and everything else builds around it. Investment number 2, Total Market Index Funds. The next investment worth knowing about is the Total Market Index Fund. Where the S&P 500 covers the 500 largest U.S. companies, a total market fund covers the entire U.S. stock market, roughly 3,500 to 4,000 companies of all sizes, from the largest corporations to smaller, mid-size, and small companies. The most widely used total market fund is VTI, the Vanguard Total Stock Market ETF, which charges just 0.03% per year. Fidelity offers FSKAX at 0.015%, which tracks the same broad index. The The performance of total market funds and S&P 500 funds is similar over long periods because large companies make up the vast majority of both indexes. The difference is that total market funds give you slightly more diversification by including smaller companies that are not in the S&P 500. For a beginner, the choice between an S&P 500 fund and a total market fund is genuinely not critical. Both are excellent. Some investors prefer the S&P 500 for its focus on large, established companies. Others prefer the total market for its broader coverage. Either works extremely well as a long-term core holding. The more important thing is choosing one and starting rather than debating between them indefinitely.
Investment 3. High-yield savings accounts. This one often surprises people when it appears on an investment list, but in the current interest rate environment, a high-yield savings account is a genuinely important tool, particularly for money you might need within the next 1 to 3 years. As of 2024, high-yield savings accounts at online banks like Marcus by Goldman Sachs, Ally Bank, and SoFi are offering annual percentage yields of between 4% and 5%. That is a meaningful, risk-free return on cash. Compare that to a traditional bank savings account earning 0.01%, and the difference is enormous. On a $10,000 emergency fund, a 4.5% HYSA earns $450 a year in interest. A traditional savings account earns $1. Same money, same effort, $449 more per year just by choosing the right bank. The role of a high-yield savings account in a beginner's financial picture is specific. It is not for long-term wealth building. The stock market will outperform it significantly over 10 or more years. It is for your emergency fund, your short-term savings goals, and any money you know you will need within the next few years. Keeping that money in a HYSA rather than a regular savings account is an easy, risk-free improvement that costs nothing to implement. If this breakdown is giving you a clearer picture of where to start, please hit the like button and subscribe to this channel. I put out a new video every single week covering practical investing and personal finance topics exactly like this one, and it is always completely free. 2 seconds right now makes a real difference. All right, back to the investments. Investment 4. Target Date Retirement Funds. Target date retirement funds are one of the most underappreciated investments available to beginners, and they deserve far more attention than they typically get. Here's how they work. You choose a fund based on the year you plan to retire. For example, a 2055 fund if you expect to retire around 2055. The fund automatically invests in a mix of stocks and bonds that is appropriate for your timeline. When you are young and retirement is decades away, the fund holds mostly stocks for maximum growth potential. As you get closer to your retirement year, the fund automatically shifts its allocation toward more conservative investments like bonds to protect what you've built. You do not have to do anything. The fund manages the transition for you. Fidelity's Freedom Index Funds and Vanguard's Target Retirement Funds are two well-regarded options with low expense ratios. Fidelity's Target Date Index Funds charge around 0.12% per year, which is very reasonable for an all-in-one solution that handles your asset allocation automatically. Who are these best for? They're ideal for someone who wants a completely hands-off approach to investing, who finds the idea of managing a portfolio of multiple funds overwhelming, or who is investing primarily through a workplace retirement account, like a 401k, where target date funds are often available as a default option. If you want one fund and nothing else to think about, a target date fund is an excellent choice. It is not perfect, the expense ratios are slightly higher than pure index funds, and the bond allocation may be more conservative than some younger investors prefer. But for a beginner who wants simplicity above all else, it is genuinely difficult to go wrong with a target date fund in the right account. Investment 5. International Index Funds. Once you have a solid U.S. market index fund as your core holding, adding some international exposure is a sensible next step for building a truly diversified portfolio. The United States represents roughly 60% of global stock market value. The other 40% is spread across Europe, Asia, emerging markets like India, Brazil, and China, and dozens of other economies around the world. By investing only in U.S. companies, you're missing a significant portion of the global economy. International index funds give you access to that broader opportunity. The most straightforward option for international exposure is VXUS, the Vanguard Total International Stock ETF, which tracks over 7,700 companies across developed and emerging markets outside the United States. It charges 0.07% per year, which is still extremely low for the breadth of coverage it provides. A common approach among long-term investors is to hold roughly 60 to 70% of their stock portfolio in U.S. funds like VTI or VOO, and the remaining 30 to 40% in an international fund like VXUS. This gives you genuine global diversification in just 2 funds. International funds do carry some additional considerations. Currency fluctuations, different regulatory environments, and varying levels of market maturity all introduce factors that U.S.-only funds do not have. Over short periods, international markets can behave very differently from U.S. markets. Over long periods, global diversification has historically smoothed returns and reduced the impact of any single country or region performing poorly. For a beginner, this is not the first investment to make, but it is a logical and worthwhile addition once you have your U.S. market foundation in place.
Investment 6. I-bonds and Treasury securities. This category is worth knowing about even if it is not where most beginners should start, because in the right circumstances, it can be a very effective tool. I-bonds are savings bonds issued by the U.S. government that are specifically designed to protect against inflation. Their interest rate is tied directly to the Consumer Price Index, meaning when inflation rises, your I-bond interest rate rises with it. During the high inflation period of 2022, I-bonds were briefly paying over 9% annual interest, significantly higher than any bank account or most bond funds. They are backed by the full faith and credit of the U.S. government, which makes them essentially risk-free from a default standpoint. The limitations are important to understand. You can only purchase up to $10,000 in I-bonds per year per person through Treasury Direct, which is the U.S. government's official website for purchasing them. You cannot redeem them for the first 12 months after purchase, and if you redeem them before 5 years, you forfeit 3 months of interest. They are not traded on the stock market and cannot be bought through a regular brokerage account. Where do I-bonds fit for a beginner? They are most useful as a home for your emergency fund or short-term savings when inflation is high and their interest rate makes them competitive with or superior to high-yield savings accounts. In lower inflation environments, they may not offer enough advantage over a high-yield savings account to make the additional complexity worthwhile. Think of them as a situational tool, genuinely excellent when conditions favor them, less essential at other times. What beginners should avoid, for now. Equally important to knowing what to invest in is knowing what to stay away from until you have more experience, a stronger foundation, and a clearer understanding of the risks involved. Individual stocks are not the place to start for most beginners. Picking individual companies requires significant research, ongoing attention, and the ability to evaluate financial statements, competitive positioning, management quality, and industry dynamics. Most professional investors with entire research teams fail to consistently beat the market doing this. For a beginner with limited time and a developing knowledge base, the odds are not favorable. This does not mean individual stocks are always wrong, but they should not be the foundation of a beginner portfolio. Build the index fund based first. Cryptocurrency is a legitimate asset class that deserves honest discussion, which means being clear about what it actually is. Crypto assets are extraordinarily volatile, largely unregulated, and driven heavily by sentiment and speculation rather than the underlying earnings and cash flows that drive stock prices over time. Some people have made significant money in crypto. Many more have lost significant money, particularly those who entered during periods of hype and exited during corrections. For a beginner building their first real investment portfolio, putting money needed for long-term wealth into highly speculative assets is a risk that the mathematics of compound growth simply cannot absorb well. If you choose to explore crypto, treat it as speculative money you can genuinely afford to lose, not as a substitute for a diversified long-term investment strategy. Leveraged and inverse ETFs, options trading, penny stocks, and complex financial derivatives all fall into the same category. They are tools that exist for specific purposes and can be used effectively by experienced investors in specific situations. For a beginner, they introduce a level of complexity and risk that is almost impossible to manage without deep experience. The cost of getting it wrong early can set your financial timeline back by years.
How to put it all together. A simple beginner portfolio. Let me give you a concrete, simple portfolio structure that works for most beginners and requires very little ongoing management. If you are just starting out and want to keep things as simple as possible, one fund is enough. Buy VTI or VOO inside a Roth IRA at Fidelity or Schwab. Set up automatic monthly contributions. Leave it alone. That is a genuinely solid investment strategy that will outperform the vast majority of more complicated approaches over the long term. If you want slightly more diversification and are comfortable with two funds, add VXUS alongside your U.S. fund. A split of roughly 70% U.S. market and 30% international gives you broad global exposure with just two holdings. Still simple, still low cost, still highly effective. If you prefer complete hands-off simplicity and are investing through a 401k or similar account, choose the target date fund closest to your expected retirement year. It handles everything automatically and is an excellent choice for money inside workplace retirement accounts. As your portfolio grows and your knowledge deepens, you can consider adding bond funds for stability, exploring real estate investment trusts for income, or gradually learning about individual company analysis. But none of that is necessary at the start. The foundation, a low-cost, diversified index fund held consistently over a long period of time, is not a starter strategy that you graduate from. It is the strategy that the evidence consistently supports at every level of investing sophistication. The best investments for beginners are not complicated, exotic, or hard to access. They are simple, cheap, diversified, and designed to be held for decades rather than traded for quick gains. An S&P 500 or total market index fund as your core holding, a high-yield savings account for your emergency fund and short-term money, international exposure once your U.S. foundation is solid, a target date fund if you want one decision to handle everything, and the patience to let time and compound growth do what they do best. The resources I have linked in the description below include books and tools that go deeper on building a beginner portfolio, understanding asset allocation, and thinking about long-term investing in a clear and practical way. Those are genuinely worth your time. Drop a comment and tell me which of these investments are you most interested in starting with. I read every single comment, and I love hearing where people are in their investing journey. And if you are not already subscribed to this channel, please do that now so you do not miss what is coming next. Next video, we are getting into the investing lessons I wish someone had told me years earlier. The mindset shifts, mistakes, and hard truths that took real time and experience to understand. Some of these lessons would have saved me money, some would have saved me stress, and a few completely changed the way I think about investing.